how teams should be valuing crypto economic security.
Can use the same capital at a million services.
I'm sure you've spoken to a lot of these LRTs. Are they prepared to
Welcome to EigenLayer Unlocked, an interactive educational journey through the EigenLayer ecosystem created by technical founders and builders for the entire crypto community. A special thank you to our partners, AllLayer, Polymer, Authentic, Skate, and Lagrange for helping to make this happen. Our goal is to raise the collective knowledge of the EigenLayer AVS ecosystem and unpack the technical designs of the top teams in space. Welcome to EigenLayer Unlocked. Welcome back to EigenLayer Unlocked. Today we have an episode with Tarun of Gauntlet to discuss a lot of the recent research that Gauntlet has been doing in the restaking space. Tarun studied mathematics and physics at Cornell, so he's got a way bigger brain than us, and has also been involved with robot ventures, doing a lot of early stage investing. Congrats on the recent fundraise there. And yeah, man, welcome on.
Great to be back. Well, I know this is a special edition. But
yeah, each time has been a special edition, the modular march into the EigenLayer.
one of these days we'll just have a regular old normal edition and have some fun.
That should be your Halloween costume, right? It's like a special, it's like a special one-time thing. Like, we're wearing a costume. We have a normal podcast for one day.
Yeah. Oh man. Well, let's jump right into kind of the core questions that Robbie and I had. We've been doing these presentations now for several weeks, really have opened our minds to a lot of the different strengths and weaknesses of EigenLayer's design, some of the innovative AVS use cases. And so we were doing some research into Gauntlet's actual research itself, and we found a piece that you recently put out titled "How Much Should You Pay for Restaking Security?" which we thought was particularly interesting, that it discussed kind of like how smart allocations to AVSs is very important. AVS is needing to provide certain amount of rewards in ETH terms to kind of help direct where these LRTs allocate. What we're trying to understand is, what is the correct mental model for valuing crypto economic security, and how should we be thinking about how teams should be valuing crypto economic security?
Yeah. So it's a great question. Maybe I'll give a little bit of history first of like how we kind of got to that result. And then, from there, we can kind of talk about what it means. So I think I want to say October 2023 or maybe September, I was talking with Sriram, and I was talking about this idea that, hey, how do people think about AVS allocations? How should they think about, which AVSs they're in, how much stake they allocate to each one? And it was kind of clear at that point that, like, one important thing in the white paper was there are some conditions on allocation that are based on security. And so sort of ironically, the source of a lot of the new research on restaking has come from Appendix B of the EigenLayer white paper, which is only like 2 pages. But it's actually the most detailed part about this idea that, like, how you choose AVSs impacts security, like how node operators decide which AVSs they choose and how they choose the sizes is actually important to the global security of the network. And you can think of that as sort of a result that says something that's local, like me, a node operator, how I choose something converts to a global property. Like, there's security across all the AVSs, as long as everyone follows some particular set of rules. And so those rules, in general, in crypto, those rules need to be incentivized, right? Like, there needs to be some reason for people to rationally follow them, which means it sort of has to be profitable to do that. And so they gave sort of an initial kind of condition on what maybe those rules look like. And then over time, I had actually done some simulations based on some old papers I had written in 2019 and 2020 on how you should think about security when you have liquid staking tokens and LSTs. And I was trying to modify them to say something about restaking in the sense of, like, hey, there's a sense in which you may want to allocate to Ethereum staked, AVS1, AVS2, AVS3. How do you determine that in sort of like some rational way? And in the numerical simulations I had, there was sort of this interesting thing where like people who had static allocations, so they picked the same AVS and they never adjusted, had sort of worse outcomes for themselves. And they also had worse outcomes for security. And security here sort of means there's a slashing event that occurs. That slashing event burns some stake. And by burning that stake, it actually potentially, if the validator was shared across multiple services, reduces the security of another network. So I think at the time last year, and this is kind of how fast this stuff moves, it's like last year, everyone was worried about the sort of like pre-launch, anything being live. Everyone was worried about this idea that there's these like cascading attacks where like an AVS gets attacked and then it reduces Ethereum's security. Right, so like an AVS getting attacked burns a bunch of stake. Now Ethereum, the amount staked in Ethereum is lower, so it reduces the security. Can that, affect the L1? And another question you might ask is: imagine I got slashed in one service. Can it affect the security of another service? And so that was a question that, from this part of EigenLayer's Appendix B in the white paper, it became clear that actually you had to consider not just how much a service affects the L1, but also how it affects other services. Because a node operator could be operating multiple services, and if they're operating the same service, and let's suppose they got DDoSed, or they went offline, or they got slashed in some way, then they affect multiple services at the same time. So there's some risk that there's correlation between them. And so I sort of had these numerical results, but I was like not, I didn't think they amounted to like a full theoretical thing. And that was around the time that Gauntlet, we started doing a lot of restaking analysis and monitoring the live networks. But in February of this year, I was at an academic conference and I was talking to a couple people about restaking. And they were like, we have this paper, we have this result about cascading attacks. And so cascading attacks against restaking networks are something where one service, you have an operator who's operating multiple services, they get slashed on one service, it reduces the security of another service, which now allows someone to attack that service, which then might make another service attackable, ... right? So it's sort of like in lending, on-chain lending, there's this notion of liquidation cascade, or in perpetuals exchanges, this is the kind of restaking analogy. Now, the interesting thing about restaking versus lending is it doesn't really depend on an oracle price as much. And so it has some extra security guarantees that are kind of different than pure lending or perpetuals. And so that was sort of one thing you have to include in the model. So these people, who are Tim Roughgarden and Naveen Durvasula, they wrote this paper, and they sort of came up with some very hard constraints that improve upon Appendix B of the EigenLayer paper to show when you don't have these cascading effects. So like if there is enough stake, like at each service, if there's sufficiently enough stake relative to how much profit you could get from attacking it, then you don't have any of these attacks. So the first sort of research that showed there's a sort of a notion of security here in which you can kind of define what it means to be economically secure. Now, their initial paper was extremely pessimistic. So like the results said you have to be very over collateralized. So this is sort of like what you see in decentralized stablecoins like MakerDAO or Sky, although now maybe they're going back to being MakerDAO, but whatever. Where you have to be over collateralized in order to get some security guarantees, and it sort of is interesting because there's some analogy. Now, what we were thinking of in this paper of how much do you need to pay for restaking securities, their paper assumed there's no incentives. They assumed sort of people were operating out purely altruistically or purely randomly. Like you had no understanding of like why they were operating a service. And so what we said is, but in reality, people are operating a service. They're running a node operator because they're getting token rewards, points, future rewards, some type of fees, something where they're making, right? Like that's just the baseline. And if you assume that, then maybe you can be less collateralized. Like maybe you can actually have a safer network with less collateral. And what we showed was something that's like, as long as there's not too much overlap, so like say I have two AVSs, as long as the sets of node operators and the amount of stake they have don't overlap too much, then you can give them AVS rewards or fees at a certain rate such that these cascading attacks don't occur. So it says like with incentives, you can actually lower the collateralization a lot. And so what that meant is it tells you something about how AVSs should think about designing their incentives based on how much their node operators overlap with other services. So there's kind of this trade-off, right? I get a lot of capital efficiency as a node operator if I can use the same capital at 1 million services. But then I create a ton of risk. And so, the way to have no risk is a node operator only validates one service, but that's not efficient, right? And so there's kind of this in between, and what our paper shows is like there is how do you compute what that in between is that's safe. It's still somewhat pessimistic. So like I'm working on another paper that's like giving a better bound, but hopefully that gives you. I know it's like a long story, but that hopefully gives you.
Yeah. It does, and I think it also says something about like how you start pretty conservative, but then you can kind of hone in on like more accurate and hopefully more optimistic results. I have a question about the way AVSs ought to think about how much APY or fees or rewards or incentives they should give to the stakers and those who are committing economic security. Is this something that AVSs should coordinate with other AVSs on, and we should have a globally coordinated system for evaluating this? Or is this methodology something that a particular single AVS can use to value economic security for its own stake?
Yeah, it's a good question. So, by the way, in response, partially to these papers, partially to other things, partially to stuff that AVSs wanted, EigenLayer created a new security model where instead of it just being purely the node operators choosing stake, the services could demand something of the following, which is like, suppose I wanted to put 100 ETH into one AVS or service. Sorry, sometimes I like calling them just service because it's just like simpler in my head than AVS.
That's what they
like,
are.
Same thing. Same thing. And sometimes you want to put 100 ETH into a service. The service has no. In the original model, the service didn't have any ability to guarantee that they could slash you. So like what I mean by that is suppose you put the 100 ETH and you're validating service A, and then you're also validating service B with the same thing. Now, suppose service A wants to slash you because you did something wrong and the other operators agree on it. But now suppose service B does sort of an MEV thing where it slashes you first. Now service A can't slash anything. So it can't cause any penalty. So like you don't get any penalty for doing the bad action. And so there's sort of this idea that service A has no guarantee on how much it can slash, right? But the new model for EigenLayer security, which has this concept of unique stake, it says that, hey, if I give 100 intuitively, like the math and the code don't exactly do this, but I think this is a simpler way of intuitively understanding is like a service is a contract, and the contract says if you delegate 100 ETH to me, 10% of that ETH is reserved, and only I can slash it, which means that I can always slash at least 10 ETH as a service, as an AVS. And so what that means is that it allows you to kind of have some amount of isolation. And we've seen this in lending and perpetuals markets where inevitably like the pooled model works really well for efficiency, but then is hard risk-wise. And then you kind of have a hybrid model between fully pooled and isolated, where like only one asset can be borrowed or lent, right? And you can kind of view this unique stake thing as, hey, I am contributing my capital to an AVS to earn yield, to operate it, to make it work. And in exchange, the AVS gets to guarantee that it can slash at least some fraction of my stake and pays me fees and stuff, right? So this unique stake thing is actually quite important because it actually means that it lowers the cost quite a bit for the service. So sorry, I know this is a long-winded answer to your question, but it's actually quite important because it's a parameter the service gets to choose. So the service can kind of think of like, hey, I really need to be able to, in the worst case, slash completely the user. Then I say I have a really high unique stake. So like maybe I'm a roll-up sequencer where the damage that can be done by an invalid sequence is arbitrarily large. On the other hand, you could consider an AVS that's maybe more like an oracle, where it's like, okay, well, if I only move the price by 1%, then the damage I can cause is 1% times the current ETH price or something. Like you have some way of valuing it. And for those, you might say, I would rather be more capital efficient and have more shared stake, right? And so I think because of this, and this is inevitable, right? Each AVS will have its own demands for security versus not security, or versus like less security, rather, not security. And because of this, they will have their own parameters that to adjust that are their own, which are like, how much unique stake do I get? Now, the more unique stake I choose, it's not free. It means that I'm going to have to sort of incentivize people more, such that if I'm saying like your ETH is only earning from me and no other service, some fraction of it, right? So there's like, how much do I want to pay for that is guaranteed to be service to me, and how much am I willing to pay for that's like potentially shared amongst any services, right? And so I think the answer to your question is like, they have to think about both. They have to think about how much they need at the bare minimum and how much they're willing to have shared. And I think the inevitable conclusion of blockchain systems is that you have this hybrid of shared and not shared, and based on your use case, you adjust it. And that's like the best of all worlds, right? In a lot of ways.
Yeah, we recently had Mike from EtherFi on a podcast, as well as a couple others in the LRT space. And we were kind of going back and forth about this topic in particular, this kind of allocation to AVSs and kind of flipping it more towards LRTs rather than how AVSs should be thinking about it, because I think that that's important, right? That there's specific use cases that can allocate a wider percentage of this total stake to be slashed versus kind of not. You know, there's very financialized use cases, as you mentioned, like a sequencer, something that is crucial for a large amount of assets. And then, you know, perhaps we have something a little bit less important that can kind of narrow down that amount. And you know, that customizability makes it particularly flexible for these services. And then kind of flipping it to the LRTs, what's interesting, what's going on with LRTs right now and the operators is that one of these two parties has to be proficient at some sort of financial modeling to be able to allocate and adjust risk forecasting and these types of things in a traditionally like engineering heavy kind of role. Like operators are like similar to like a validator who runs, and LRTs are probably more financially savvy. So kind of coming to this state of LRTs allocating their stake across AVSs, how can LRTs use proper risk modeling to prevent or minimize any sort of systemic risk? And kind of like how are you thinking about the way that these LRTs should allocate stake across AVSs?
Yeah, great question. So, you know, the papers between Rough Garden's paper and my paper, they kind of get at this idea that like there is some in a very over collateralized version, you have no systemic risk. So we know like when systemic risk exists and when it doesn't exist. But then of course you want to find the efficient frontier, right? Like you want to be at like no systemic risk, but also efficient capital, like high returns effectively, right? And that's the Goldilocks state. I like to think about restaking it as sort of in between pure staking and node operation and DeFi, right? It like has some aspects of DeFi, but it has a lot of guarantees that DeFi doesn't have, right? DeFi has to rely on oracles, it has to rely on liquidity in a certain way, it has to rely on a bunch of other things. I think restaking's dependence on those same things is generally a lot lower. And part of the reason for that is you're using the same unit of account at every service. Like you're restaking ETH Now, obviously, you can restake multiple tokens and whatever, but realistically, the largest portion is going to be stealing. So there's sort of a sense in which you can kind of it's like lending or perpetuals, but like you are bounding the risk a little bit, and that's why I think you see this, duality of man thing of like the finance side versus the pure tech side, right? Like it is actually like in the middle, and that's personally why I find it the most interesting. But I like to think of, if we do some TradFi analogies first before we get back to the LRTs, I like to think of, the normal token market is like closer to equities and like lending protocols like Aave, Morpho, Compound. Those are like stock loans. Like I borrow against my stock, I get some cash, maybe I get liquidated because the stock drops, right? Those are very volatile loans that they generally have low predictability because there's not really like revenue, right? Like I'm borrowing against a stock, but if the stock doesn't have dividends, then there's no real revenue. So I'm not borrowing against like future income. I'm borrowing against exactly what's there. So I have to be conservative. On the other hand, most loans in the normal world are borrowing against future income, right? Like a mortgage is borrowing against my future income to pay for this house now, and then I pay it over time, right? And most credit in the world is not like that. Now, stakers have the most interesting form of credit. They have a sort of cash flow coming in. They have the block rewards that are somewhat predictable. Now, they're not that predictable in the sense that like, hey, someone could just add a bunch of ETH to the pool, dilute my return, and now I have fewer block rewards. They could add, the fees might go down because the L2s are taking all the fees, or whatever the reason is. So they still have variance, but they're much more predictable, right? Like and that's why you should really think of, basic staking as like the bond market. Like there's some, the default conditions are getting slashed, but it's like generally a lot more predictable and less, so you can be less conservative on lending. That's the other side of this is like the biggest lending market in the world is the repo market for treasuries, which is like tens of trillions of dollars, that exists daily. So it's like huge. So there's sort of this natural analogy then that like restaking, and I know people don't like thinking about the rehypothecation aspect because like you have a lot more safeguards on chain, like the L1 contract can slash you immediately. It's not like rehypothecation in the real world where like if someone fucks up, I have to go sue you, right? It's like it is different in that way. But there is a sense in which the payoff to the node operator looks a lot like getting leverage on my stake, but in a predictable way without going to Aave or without going to something where I'm taking a lot more relative risk because I don't know what the borrower quality is. When I think about the AVS as a borrower, their quality is much cleaner to assess. It's much more about the kind of credit rating of the AVS, what the historical fees look like, what their token looks like, all of these things, right? So because of that, it's like really like the bond market, except you have a lot more protection because you do all these things that you don't need a legal system, right? That's the beauty of crypto. You can have all these conditions for getting slashed and rewarded. So I think if you take that lens that AVSs are like the bond market, there's sort of a sense in which AVSs need to like generate predictable revenue. And I think one of the reasons the roll-up, restaked roll-ups and the decentralized sequencers are, at least from a naive standpoint, quite attractive as AVSs is we know they have regular revenue that you can then use to kind of decide how to think about this for. And so my suspicion is that the AVS market will unfurl in that it will start very bimodal, where there'll be like this huge set of companies that is, or AVSs, companies that are building AVSs, that is very predictable revenue, like things people know have revenue. Oracle is restaking rollups, whatever. And then there's going to be this like whole like pure VC thing of like AI models and whatever. And then over time, people will learn a lot about them as they're live, and they'll learn about the reward profiles, they'll learn about the slashing, and you'll slowly get more of your normal distribution Gaussian thing of like things that generate a lot of revenue, things that generate very spiky revenue, maybe might die, and you get kind of the whole bond market. And because of that, you need to think of the risk reward of the market in that way, I think, a little more than like pure tokens, where it's like more like equity, where you really have to be more conservative. And I actually think the interesting thing is you can be more aggressive on the efficiency side in restaking than you can in lending and perpetuals. And that's kind of why it captivates me, but also is like why I spent so much time trying to write the math for this, is like showing that that's true is still, it's like you intuitively feel it, but you don't have the exact kind of math yet. And like, I think we're like, to your point earlier of like, you start really conservative and you get more and more efficient. It feels like there's more steps you can take in restaking efficiency wise than you can in DeFi.
That's a great parallel to the bond market. And so, I mean, like, I'm sure you've spoken to a lot of these LRTs. Are they prepared to like, do they have the financial?
I forgot. I didn't even really answer your question about the LRTs. I think the thing is like, I think the LRTs are like bond funds, or honestly, and like people will hate that I say this, but they're like, they look a little bit like CDOs from like the financial crisis that like bundle a bunch of mortgages and securitize them. It's very similar. I will say the naming of the thing LRT squared is almost too on the nose, because there's a thing called the CDO squared from the financial crisis that blew up very poorly that like it reminds me of, but maybe it's because I'm old and everyone else is 10 years younger than me or whatever. But I think there's kind of this kind of funny thing that it's like, yeah, the LRT is going to be sophisticated, and like everyone knows all the funds that blew up in the financial crisis, but no one talks about all the funds that made tons of money and like figured out how to manage the risk afterwards. And like, it's not like the CDS market went to zero; it's still like $10 trillion market. So like, my point is like, you have these collapses and crashes, but from those, you're able to learn how to make it very sustainable. And I think LRTs are going to have the same reckoning, where someone is going to blow up. They're going to have chosen only the riskiest things. And we saw this in DeFi Summer, where after Yearn was successful, there are 5 million like yield aggregator clones. And the only thing they differentiated on was like how far on the risk curve they're going to go. Like, what new protocol were they going to integrate?
It also happened with,
just blew up.
Yeah, Cream Finance is one that comes to mind.
Exactly.
On the lending side, their entire edge was like you could just borrow against anything.
And Alameda destroyed them over that. Yeah, like ironically.
Yeah.
Yeah. So like, my point is like, there's inevitably going to be the ones who blow up, right? Like, but you can't control that. And I think the beauty of the decentralized world and transparent world is you can see all their positions. In TradFi, the CDO market, CDS market, you can't really see those positions. So like, one reason I think the financial crisis was actually worse in some ways, and this is my opinion, there's some data suggesting this, but I would say it's mixed. But it's just so I'm disclaiming that, is when you think about a mortgage that defaults, it's not like, and imagine there's a bank that securitized a bunch of mortgages and then sold it to investors. So like, investors are like, own this portfolio of like 5 mortgages. Now suppose one of those mortgages someone doesn't pay for a few months. You don't have like, it's not like the security, like the thing the investor owns immediately prices the default. Like the thing defaults, then it like is in foreclosure, and then maybe it goes to court, and then eventually, after it's actually, somehow the title changes, then the security suddenly gets repriced, right? It's like, whereas in crypto, it's like immediate, right? Like, if there's a default event, atomicity and composability mean it's like already at the end. Like, every possible person who depends on that state transition has already gotten it, right? That's a very different world than the world that we see in the TradFi world. And that's also a reason why you can make these things safer, because you can put all these safeguards when you know they're atomic and composable, and you're not like waiting 5 years for some fucking random municipal government to tell you this house is in foreclosure.
Yeah, it's a much more dynamic world, right? And so when these LRTs are thinking about reallocating, and I think there's allocating, when everything is fun and good and like very normal equilibrium circumstances. And then there's reallocating in the case of some weird thing happening. And so in that case, everything moves much more quickly because everything is programmatic. And so what kind of programmatic controls do you anticipate these LRTs or even like, these guys that are just running Eigen pods with their own ETH and not in LRTs? What kind of programmatic controls could they have or should they have to reallocate risk in sort of a black swan event?
Yeah, it's a good question. So I think a couple things are, one, being cognizant of the overlap between operators of the same service. Like, will they all get slashed at the same time? Will it be correlated in the same way that you had this kind of like correlation event, the financial crisis? Like, sorry, I keep referencing the financial crisis, but like, it's just a very easy analogy to make of like
the thumbnail's going to be Tarun restaking financial crisis.
No. That's definitely not what I'm trying to say. I'm just like, well, the funniest thing is I wrote, so slightly long story, but why I got into thinking a lot about restaking before it was live, like kind of when, I mean, I was one of the first investors, but that was more because like, I think Shriram had a really good idea, but I think the way it was presented in the beginning looked a little bit different than restaking. And when it kind of, once it was kind of more like restaking, the number one thing that I've been thinking about is I wrote this paper in 2019 and 2020 with Alex Evans from Bain about how to model LST risk. And the interesting thing is we made this model and showed these properties, which basically showed that like an LST is sort of in a lot of regimes very similar to a mortgage-backed security. It like has a lot of properties of mortgage-backed securities. You can think of the mortgages as each node operator's non-fungible position of locked ETH in this case, and the LST is this basket of them. And like if all of them default at the same time, they all get slashed at the same time, your LST could be worth less than what you think. And so I had sort of been like, oh, this restaking thing has to be kind of credit default swap bond market like, because if the LSTs were like that, then like this has to have some flavor, and it doesn't have to be exactly the same, right? Like, again, the main important thing is that in a programmable money world, these covenants in a loan, like, oh, if this condition happens, you're defaulted, or if this condition happens, we pay you. In the real world, those don't happen like instantly at the right time. They happen kind of slowly by osmosis and between 9 to 5 or whatever, right? But the idea that those happen immediately means that now I can put in conditions in the contract that are like, if these two events happen at the same time, do X. So if I get slashed in A and slashed in B, then do Y. And this is the type of thing an LRT can do in response in a way that you kind of can't do in the normal world. It's like the correlation is truly there, like, but you don't see it because it's not transparent and it's not obvious to you. And I think blockchains allow you to actually have that be extremely transparent. And so you can now put all these extra conditions that are like, if these two things happen, reallocate, move my ETH, do whatever, right? And I think that our initial paper kind of was built around showing something like that. And the title of that paper was like, what proof of stake can learn from mortgage-backed securities, which is kind of similar to the thing you're saying. But like, I don't want to like raise the alarm bells. I want to more be like, hey, those things are like maligned, in my opinion. I think like credit default swaps is still a big fucking market. It's not like it went to zero, right? And it's because it's useful and people get value out of it. It's like a better form of insurance. And if you look at a lot of the stuff in restaking, like StakeSure, a lot of the insurance sounding things within restaking, they have a lot of that in it, except because it's programmable, you can do a lot better. And like, we should be thinking about how you can do all that stuff better. And like, that's, to me, that's sort of how I view this, is like, I can write code. This is, if these two events happen together, like, get the fuck out of this other AVS, right? Like, I can't really do that in TradFi right now. It's like too many disparate systems. They might not tell me the state of everything immediately. It's just like, you don't get this atomicity stuff is like extremely important to risk management, which I think TradFi people don't have. They hope for the legal system to make up for lack of atomicity.
I mean, for all those advantages, would you say that it's just a matter of time before this whole reverse repo market, $10 trillion credit bond market is on chain?
I would love to see that. I mean, I actually think like the credit default swap market itself should probably, like, on chain makes way more sense than this bilateral party shit that we have. It's also a market that I bet you would be 10x the size if it was global. So it's a market that's extremely local. Mortgages and credit default swaps and bonds are very tied to whatever country they're issued in. And we live in a world of the internet. Bonds should not be restricted to one country or one place. Liquidity shouldn't be restricted. And like all crypto has shown you is that you give people the advantage to not have to think about that. You can get a huge amount of growth. And I generally think like that's going to be true for this stuff too. And that's why restaking is exciting, because like if there are real services that are not roll-ups that generate a ton of revenue, that's like an international company that anyone in the world can buy the bonds of. That's kind of what you're, like you can't do that very easily. I mean, the bond market is even harder to trade than the equity market, right? So like access-wise.
Yeah, I think that goes back to your previous point, and I wanted to kind of double click on that as far as the revenue of rollups. I had a really good presentation with Amrit AltLayer, and that was the thing that particularly like stuck out to me. We've asked a ton of these different AVS projects or services, like basically where's the demand going to come from, where's the yield going to come from, who's going to kind of make this work, and the decentralized sequencing answer was definitely one of the best as far as a clear product market fit in today's world. But then kind of to flip that on its head, if these AVSs or if these services all launch tokens, which to me is still kind of fuzzy, because my initial unique value proposition of EigenLayer and restaking is like you can bootstrap your own service or your own network without having to kind of launch a token and launch this proof of stake token and go down that kind of path, which is clearly not going to be the case, because these AVSs are funded by VCs. There's liquidity, tokens are the way. So this kind of brings me to like a two-part question, which is, one, in the immediate term, is the revenue really going to matter if there's token incentives to kind of and token emissions that can be basically forecasted as revenue? And two, how are we thinking about the value of AVS tokens and service-based tokens compared to like a L2? What's your mental model there for these tokens?
Yeah, and
because they're still yet to be launched.
I apologize for always thinking about everything in terms of like basic finance, but the math always makes more sense to me. And I would say the interesting thing is, like, in normal companies, you have derivative instruments like safes for raising money that are effectively bonds that deliver a interest rate in equity, right? So it's like a safe, I bought this derivative and I get a discount and a valuation, and based on the next valuation, I get I get some guarantees, but my interest rate and arguably my principal, depending on how you look at it, is effectively paid in equity. I think the interesting thing about tokens is people flip that. They have like an equity product that is like converting itself to a bond over time, right? It's like, I'm paying you these blocker words until I get fees, and then it becomes a regular thing, right? So think about Ethereum. It's like, I'm paying you an equity in Ethereum block rewards to participate in the network with the belief that there's future fees, and those fees will be regular, predictable, ... like some kind of understanding of them. And then if that's true, then I become a bond, right? Which is like, if you think about ETH, it like had this reverse transition of what a safe, like a kind of a company would raise early money on, these convertible note type of thing. It's sort of the
and AVSs had that as well recently. If you see the chart, they did full emissions for like the first 2 years or 3 years. That was like the main source of revenue, and now those have stopped, and it's pretty much fees.
And I mean, like, capitalism is capitalism. Like, you don't fucking make fees, you're not surviving a long time. Like, I don't care what meme coin bullshit tokenomics thing you do in the long run. Like, in the short run, you can do stuff, but I think eventually you have to be able to convert equity to bond. And like, that is kind of an interesting thing about crypto. Because if you have programmatic money, it's much easier to adjust how you emit your equity as a function of your fees, right? Like EIP 1559 is a great example of that. And because of that programmatic thing where I can control that and I can do it continuously, as opposed to these kind of like in the normal stock market, I have to like, I can't like just like, oh, today I'm going to emit 1.375 shares of my company and sell. You know, it's like, that's not happening. It's like I have to do a tender offer and all this other stuff, right? Like, but the idea that I can program this thing until I reach a point of sustainability, until I reach a point of fees, and I can do experiments with how this kind of like equity-like thing eventually converts to a bond-like thing. This is why you should never view tokens as pure securities, because like they kind of have this amorphous chameleon nature where they go between these things. And I think restaking will be the same thing. I just think, you know, having been in crypto for a while, sometimes you just don't see where that comes from, right? Like, you don't see where the new asset creation or fee creation, if I split them into two, comes from, right? Like DeFi Summer was sort of a weird one where like asset creation was correlated with fee creation because like every new asset created more trading or lending volume, which created more fees. And you had this feedback loop, which is, I think, what really grew it then. Whereas like L1s, you don't quite have that. L2s, you definitely don't have that. But I think restaking is actually something that looks a lot like DeFi. And a lot of the reason I think restaking, I don't have too much to add to this, are L2s parasitic to L1s debate. But I will say one thing. I think restaking improves the monetary premium and the moneyness of the staking asset. Because if I look at the rest of the world, the countries that have the most liquidity for finding new yield opportunities have generally the largest bond markets, right? So it's like the US, I can do tons of borrowing against my bonds and reinvesting in other things. Whereas I look at countries that like can't do that, like Turkey, where it's like, oh, the bond pays me 50% in the local currency, but people still don't want it. You know, it's like clearly there's like something going wrong, right? Like, and sort of there is this natural thing in which how much liquidity you're able to attract kind of determines your success. And so if you're a proof of stake network and you want to cement yourself as money, the ability for people to borrow in different ways against their stake and use it for new asset creation, that inevitably becomes a way of getting more and more liquidity, and you become more and more like money. So I think for proof of stake assets, restaking actually, it almost ironically, given how much Bitcoiners would hate this, but it makes it more like money in some ways. It like gives it more of the moneyness property. And I think that is one of these financial things that like I've been trying to figure out how to write the math for and like get a more real like result for. But I it's just intuitively that sticks out to me. Is like roll-ups don't necessarily accrete value. You know, like I'm sure there's MEV and other stuff that does, and there is of course the like if they use the same base asset, there is some premium, but I think it's much smaller than the restaking premium. And I think in the long term, the AVSs that figure out how to correctly turn this, we start with incentives as equity and then convert to like, hey, we earn a lot of fees, that's going to win in the long run. And whatever we see right now will likely not be the one that is like the best at that. And that's the beauty, that's the joy of crypto, right? It's like you're always like finding something you're crazily surprised by that's able to generate all that revenue.
Yeah, I think that's a really good way to put it, right? So right now, I think we'll start to see a lot of these AVSs eventually, and these services launch their own tokens. There will probably be a wide cast net from LRTs based on the different risk parameters that we spoke about today, and then kind of consolidating back into that normal distribution curve that you kind of spoke on in the future as the ones that actually generate fees. earn staying power. And then this is all bullish for ETH. ETH's money, ETH, the asset, is a big beneficiary of this. I just have one last question, and I don't know if Rob does. I know that we're running low on time. There's a notion of we should be able to restake anything. We should restake Bitcoin. We should restake Tether. We should restake Near. We're going to restake Eigen and slashing. We haven't even talked about slashing today. We could do a whole episode of slashing. What are your thoughts about this idea of being able to restake different types of collateral? How should we be thinking about like the risks there and the idea?
I think it's sort of dual to this LRT question of AVS selection, in the sense that like the types of collateral accepted kind of changes the credit quality of the AVS in a lot of ways, under slashing events and other cases. So like, for instance, USDC staking or USDT staking seems fine, right? Like all you're doing is lowering the volatility of rewards. You're also making you're making the equity like investment much more like a pure bond like investment. If you imagine those were yield bearing stablecoins, it's almost like having a portfolio of stocks and bonds, right? So in that case, it actually makes a ton of sense. So like maybe the person restaking doesn't want to take as much risk, and like this is a way of hedging for them. And it's a way of hedging that's very intuitive and easy to calculate, kind of the risk you're taking, right? Because like adding.
But I would just push back on that though.
Yeah.
Because if you have like off-chain asset, like ETH as an asset,
you mean
for
like
example,
the RWA risk.
Right. Like that's like that.
Yeah,
that is like
fair.
You can be mint to zero instantly, whereas ETH is likely not going to drop 80% in a given hour.
That is true. That's true. That's a very fair point. That I'm ignoring the blacklist and rug risk.
And then
aspect.
we can restake Doge. It might be safer than USDC.
Yeah. No.
Or something
that
like
is
Frax or DAI.
Yeah.
Just something totally on chain.
I basically wanted to start with like, okay, something that lowers volatility.
Yeah.
Is like kind of a reasonable thing. Something that increases volatility but doesn't increase the rewards doesn't help you with security, right? Because it doesn't make it more likely that node operators are going to stay and keep their stake locked in. So there's clearly some threshold of asset quality between like lower volatility and minus the off-chain risk. Let's pretend it's like DAI or something. Something where we have more confidence that it's that lower volatility, lower reward, but it's sort of like I'm a more conservative restaker, higher volatility, higher reward, and then higher volatility, lower reward. Because higher volatility, lower reward can easily happen, right? Like imagine that an AVS pays rewards as a function of the ETH value of what you're staking. Now imagine I stake shitcoin 5, and shitcoin 5, like its ETH value goes up because it just was launched on pump.fun on base equivalent, and it looks like I'm staking a ton, and like the first reward thing I get a million ETH of reward. But then imagine that it crashes 90%, and now I get nothing, right? Like clearly there's some that have this negative cost, so there is clearly this threshold. And I once again will bring everything back to thinking about the bond market, in that if I had Turkish lira and I go to an American company and I say, hey, would you allow me to buy your bonds in Turkish lira? I'm not going to convert them to dollars as the principal. I'm going to give you Turkish lira. The company would say, all right, I'm giving you insane discount or insane premium. Like you have to pay way more, right, to accommodate for that. That's like the same exact thing, right? And this is historically why bonds are very localized to their markets. Now, obviously governments regulate them, but also it's like the people who are accepting it have to want to accept the principal currency that they're taking the initial principal. I think in the internet bond, you have to be, because trustless, it's going to look different. But that's a new set of cool challenges. And obviously there's going to be some that have horrible credit quality. Great. But I think like in the long run, vault operators and LRTs and stuff like that, like this, what are you paying them a premium for? It's like this, right? Like,
yeah. And then I'm curious then how you see Eigen token fitting into this model of risk versus reward effectively, or volatility versus staking yield or yield in general?
I think there's Eigen is probably one step beyond restaking in all of the financial analogies I make, which is why I think it's like it's thinking a little more galaxy brain than even the way I'm thinking of things. Because I try to always think of, again, everything, I try to turn everything into like boring but like simple finance stuff. I think the long-term goal of EigenLayer at large is verifiable cloud, right? Like notion of cloud services, I can verify anything or everything that's going on. Inevitably, that has some things that are, let's say, subjective decisions amongst node operators, and maybe you have to say the word intersubjective somewhere to reason about it. In that world, I sort of view Eigen token as the thing that is the excess value created by having this full verifiable cloud over just the bonds, right? And the value Eigen itself as a token is like that delta. Now, I think the verifiable cloud stuff, obviously we have proven out, if not product market fit, insane demand for the bond market, right? Like there's no doubt that all these people with a ton of assets staked and we're like, I want more yield and I want it in some way that's predictable and lower variance than like lending it. They flooded in with $15 billion, right? Like that is representing the restaking aspect. But the verifiable cloud aspect has this dispute resolution aspect on top of just the bonds, right? Dispute resolution is very hard. In the normal world, it comes down to legal contracts. So one of the most difficult dispute resolutions, and I'm saying this one because this one is an intersubjective dispute. And even though it's a TradFi boring world dispute, it is actually meets the definition of intersubjective dispute where there was a fork, which is Argentina sold a bunch of bonds in the US, forget exactly the year, and then over time kind of synthetically defaulted, didn't pay, whatever. And a bunch of hedge funds, namely Elliott Management and a few other people, bought a lot of those bonds at a huge discount. And then the Argentine government and the US government, or US court system, negotiated on bankruptcy with the of those, like, default of those bonds with the holder. And these hedge funds who had like some minority percentage, so less than 50% by a lot, held out. They said, like, we're not taking the settlement. Like Argentina, the country, agreed with most of the bondholders, and these people held out, and they held out for like 10 years, and then they eventually got paid out. And the court system here, but in Argentina, this was viewed as illegal. Like this was like not a real thing. But the problem is they issued the bonds in the US. So they're custodied in the US. The US was the L1 that was managing that. And Argentina, the L1 was like, fuck you, we don't recognize this. And then 10 years later, they eventually came to some agreement. So Argentina forked and then they merged again. And you could kind of view this dispute as like the reason you need this intersubjective thing for the verifiable cloud. That's like the finance answer. Is that the bond market could actually exist without this resolution if you have very clear default events, like clear slashing events, like you didn't send a block in 5 seconds and everyone gave timestamps and showed you didn't. But for these more unclear ones, which are like this Argentina thing, I think you do need to you do need this extra layer, and that's what the Eigen token values. Now the question is, we need AVSs live that are getting in disputes over, for this to work. So
yes,
it's very forward thinking.
Yes, we do.
It's like in my mind, it's like the corporate bond market existed for decades before we started getting all these like 1980s onwards intersubjective disputes that were like, which kind of resemble the forking. So again, I apologize for my always bringing everything back to financial history, but I do think there are analogies to this intersubjective stuff that exists.
Yeah. Yeah, epic conversation, Tarun. I mean, we touched on kind of how to value crypto economic security, smart allocations to AVSs, AVS yields, revenues, kind of the how we'll see the power law play out there, LRTs allocating stake to AVSs, how kind of you and Gauntlet are thinking about that, and all of the parallels to the CDOs and kind of bonds throughout the entire conversation. Tokens, valuations. All I can say is this has been a banger, and thanks for coming on.
Thanks for having me.
Very helpful.
I appreciate your financial analogies. I think they're stronger than just analogies. I think they set their precedents.
Well, I just think it's like easy to reason about, you know, it's like, because I feel like there's always new words in crypto. And if you reduce them to old words, then you're like, oh, I know these old words mean this.
Yes.
Reductionary, spoken like a true mathematician.
It's just easier.
Thank you,
Thanks,
guys.
Tarun.
Thanks so much.